Silver is often discussed as a single market, yet in practice it operates through two parallel systems that behave very differently under stress. On one side is the paper market, built around futures contracts, unallocated accounts, and derivatives that reference silver as a financial instrument. On the other side is the physical market, where metal must be refined, transported, stored, insured, and delivered. Understanding the structural shift now underway begins with recognizing that these two layers are no longer moving in perfect alignment. The paper-silver market is dominated by futures trading on major exchanges, with contracts that represent obligations to deliver silver at a future date, but are overwhelmingly settled in cash or rolled forward. Daily trading volume in futures often represents many multiples of annual global mine production. This does not imply wrongdoing. It reflects the role of futures as a hedging and price discovery mechanism. Producers hedge output, industrial users hedge input costs, and financial participants express macro views. The result is deep liquidity, tight spreads, and the ability to move large nominal volumes without requiring immediate physical settlement. The physical market operates under different constraints. Mine supply grows slowly, typically in low single-digit percentages per year. Recycling adds flexibility, but it is price-sensitive and cannot scale instantly. Refining capacity, bar fabrication, and logistics impose additional bottlenecks. When demand for physical delivery increases, these frictions become visible through longer delivery times, higher premiums over spot prices, and tighter availability in wholesale vaults. Recent years have shown a widening gap between the scale of paper trading and the availability of deliverable inventories. Exchange warehouses and approved vaults publish inventory reports that distinguish between registered metal available for delivery and eligible metal that meets specifications but is not committed for settlement. While these figures fluctuate, the broader pattern has been a relatively modest buffer compared with the notional exposure represented by open interest. This does not automatically signal shortage, but it does increase the system's sensitivity to shifts in delivery behavior. Industrial demand has become a central driver of this shift. Silver is no longer primarily a monetary or jewelry metal. It is a critical input for photovoltaics, power electronics, automotive applications, and advanced manufacturing. Solar panel production alone now accounts for a significant share of annual silver consumption, with estimates commonly ranging between 10 and 15% of total demand, depending on technology mix and efficiency improvements. Electric vehicles use silver in power management systems, charging infrastructure, and battery-related components. Consumer electronics, medical equipment, and data infrastructure add steady baseline demand that is less sensitive to short-term price movements. This industrial profile changes the character of silver demand. Unlike investment flows, which can reverse quickly, industrial consumption is tied to production schedules and contractual supply chains. Manufacturers cannot easily substitute away from silver without redesigning components or accepting performance trade-offs. As a result, demand tends to persist even during periods of price volatility, creating a more rigid underlying consumption base. At the same time, mine supply faces structural limitations. A large portion of global silver production is a byproduct of mining for copper, lead, zinc, and gold. This means output is influenced more by base metal market conditions than by silver prices alone. When base metal investment slows, silver supply can stagnate even if silver demand remains firm. New primary silver projects require long permitting cycles, significant capital expenditure, and years of development before production begins. These realities limit the speed at which supply can respond to sustained increases in consumption. The interaction between futures markets and physical delivery becomes especially important during periods of tight supply. Futures contracts include mechanisms for delivery through exchange-approved vaults. When holders of long positions choose to stand for delivery rather than roll contracts forward, the system must source physical metal that meets specific quality and location standards. Under normal conditions, this process is routine. Under tighter conditions, it can lead to higher lease rates, elevated backwardation in certain contract months, and visible drawdowns in registered inventories. Volatility in silver prices has increased not because of dramatic narratives, but because the market is absorbing multiple sources of stress simultaneously. Macroeconomic uncertainty affects interest rates and currency expectations, which influence investor behavior. Industrial demand continues to grow, anchoring physical consumption. Supply remains relatively inelastic in the short term. When these forces intersect, small changes in positioning can produce outsized price movements. Professional buyers and institutional participants tend to focus less on headline price action and more on market structure indicators. These include spreads between spot and futures contracts, the cost of borrowing silver in the lending market, warehouse inventory trends, and delivery volumes during contract expiration periods. When physical premiums rise while futures prices remain stable, it often signals localized tightness rather than speculative excess. When inventory turnover accelerates, it can indicate that metal is moving through the system more quickly to meet end-user demand. Retail participants frequently misinterpret these signals. One common assumption is that rising open interest automatically means speculative buildup, when in reality it may reflect hedging activity by producers or industrial consumers. Another is the belief that any inventory decline implies immediate shortage, without considering the distinction between metal that is available but not registered for delivery and metal that is truly absent from the system. These misunderstandings can lead to emotionally driven decisions rather than disciplined allocation. What is changing now is not a single price level or a short-term trade setup. It is the balance between financial liquidity and physical constraints. As industrial demand becomes a larger share of total consumption and supply growth remains constrained, the margin for error in the delivery system narrows. This does not require extreme scenarios to have an impact. It simply means the market becomes more sensitive to shifts in behavior, particularly during periods when futures contracts approach settlement and physical demand peaks seasonally. For long-term participants, the key is to view silver through the lens of infrastructure rather than speculation. The metal sits at the intersection of energy transition, electrification, and digital expansion. These trends evolve over years, not weeks. The paper market will continue to provide liquidity and price discovery, but the physical market increasingly defines the boundaries within which that price discovery operates. Recognizing this distinction is the foundation for understanding the structural shift that is taking place. As this structural tension becomes more visible, the mechanics of futures delivery and inventory management move from technical background details to central market variables. Futures contracts are standardized agreements that specify quantity, quality, and delivery location. In silver, each contract typically represents 5,000 troy ounces, and settlement can occur either through offsetting positions or through physical delivery via approved warehouses. Historically, only a small percentage of open contracts result in physical delivery. This has allowed the market to function efficiently with a relatively small pool of registered metal compared to the notional volume of paper trading. The dynamic begins to shift when a higher share of contract holders choose to take delivery. This behavior is not driven solely by speculation. Industrial users sometimes secure metal directly through futures delivery to lock in supply at known costs. Institutional investors may also choose delivery as part of portfolio allocation strategies that prioritize direct metal exposure over financial instruments. When delivery demand rises, warehouses must allocate registered inventory, and if necessary, convert eligible metal into registered form, a process that requires administrative coordination and physical availability. Inventory data published by exchanges and vault operators provide a window into these flows. Registered inventory represents metal that is immediately available to meet delivery obligations. Eligible inventory meets quality standards but is held by private owners who have not committed it for delivery. A decline in registered stocks without a corresponding increase in eligible conversion suggests that metal is leaving the delivery system rather than simply being reclassified. Over the past several years, periodic drawdowns of registered inventory have coincided with elevated delivery volumes during contract expiration months, indicating that more participants are choosing to settle in physical form. Another relevant indicator is the cost of borrowing silver in the wholesale market. Lease rates reflect the price paid to temporarily access physical metal. When supply is abundant, lease rates remain low and stable. When demand for immediate delivery rises, lease rates can increase, signaling tighter availability. These changes often occur before they are reflected in headline prices, making them valuable early signals for participants who monitor market plumbing rather than surface-level price charts. At the same time, the role of exchange-traded products and custodial holdings adds complexity. Large, silver-backed investment vehicles hold substantial quantities of physical metal in vaults, often in London or other major financial centers. These holdings are not automatically available for futures delivery, but they influence overall market liquidity. When investor inflows increase, these vehicles acquire metal, reducing the amount circulating in the wholesale market. When outflows occur, metal may re-enter the system, easing short-term tightness. The timing and magnitude of these flows can amplify or dampen delivery pressure depending on broader market conditions. Industrial demand continues to operate on a different timeline. Solar manufacturers, electronics producers, and automotive suppliers typically secure silver through long-term contracts and just-in-time inventory management. Their priority is continuity of supply rather than short-term price optimization. During periods of strong end-market demand, these buyers are less sensitive to moderate price increases and more focused on ensuring availability. This behavior can absorb physical supply even when financial participants are reducing exposure, creating a divergence between investment flows and real-world consumption. Supply constraints remain a persistent factor. Global silver production has shown limited growth, with annual output fluctuating around a relatively narrow range. Temporary disruptions from labor issues, energy costs, or regulatory changes can remove meaningful volumes from the market. Recycling provides an important secondary source, particularly from industrial scrap and photographic waste, but it is dependent on collection infrastructure and price incentives. When prices rise, recycling tends to increase with a lag rather than providing immediate relief. These structural features explain why volatility has become more pronounced without requiring extreme narratives. When inventories are lean and delivery demand increases, price movements can become sharper as participants adjust positions. This does not imply instability of the market itself. Rather, it reflects the market's attempt to balance competing demands for liquidity and physical availability. Professional market participants often interpret volatility in this context. They analyze term structure, looking at whether futures curves are in contango or backwardation. Persistent backwardation in near-dated contracts can indicate tight physical supply relative to immediate demand. They also monitor the ratio of open interest to registered inventory as a measure of delivery leverage. While this ratio alone does not predict outcomes, changes over time can signal shifts in participant behavior. Retail investors frequently focus on headline narratives or short-term price targets, overlooking these deeper signals. A common misconception is that futures markets exist solely to suppress or inflate prices, rather than to facilitate risk transfer and hedging. Another is the assumption that physical and paper markets are inherently disconnected, when in reality they are linked through delivery mechanisms, arbitrage, and inventory flows. Misunderstanding these relationships can lead to unrealistic expectations about how quickly structural changes will manifest in visible price trends. What is emerging is a market environment where physical considerations carry more weight in shaping outcomes. The increasing share of industrial demand, combined with limited supply growth, means that the buffer provided by inventories is thinner than in previous cycles. This does not remove the role of financial participants, but it changes the balance of influence. The futures market still sets reference prices, yet those prices are increasingly constrained by the availability and movement of real metal. For serious buyers and institutional participants, this shift encourages a more integrated approach. Instead of viewing silver solely as a trading instrument, they assess it as part of a broader supply chain. They evaluate counterparties, storage arrangements, delivery terms, and logistics resilience. These factors, while less visible to the public, are becoming more relevant as the market adapts to evolving demand patterns and structural supply limitations. The broader implication is not an imminent crisis, but a gradual recalibration. As delivery pressure, inventory management, and industrial demand intersect, the market's internal mechanics become more important in shaping behavior. This is the environment in which silver is now operating, and it sets the stage for the longer-term adjustments that are already underway. Beyond the mechanics of delivery and inventory, the structural shift in silver is also reflected in how different classes of buyers interpret information and respond to market signals. Institutional investors, industrial consumers, and physical buyers operate under distinct constraints, and their actions increasingly diverge from the simplified narratives often presented in mainstream financial coverage. Large institutional participants tend to frame silver within broader portfolio and macroeconomic strategies. For them, silver is not only a commodity, but also a component of inflation hedging, currency diversification, and real asset allocation. When real interest rates are low or uncertain, demand for tangible assets often increases. However, these institutions rarely rely on spot prices alone. They analyze correlations with energy markets, base metals, and industrial production indicators. They also monitor policy signals related to renewable energy incentives, infrastructure spending, and trade regulations, all of which influence long-term demand for silver-intensive technologies. Industrial buyers, by contrast, focus on operational continuity. Their purchasing strategies are driven by production schedules and contractual obligations to downstream customers. For a solar manufacturer, delays in securing silver paste can disrupt output targets and revenue forecasts. For an automotive supplier, shortages can affect delivery commitments to vehicle producers. As a result, these buyers often prioritize reliability over marginal cost savings. In periods of tight supply, they may accept higher premiums or longer-term contracts to ensure consistent access to material. This behavior can create a steady underlying bid in the physical market that is not immediately visible in futures price movements. Physical investors, particularly those acquiring bars and coins for long-term holding, represent another layer of demand. While smaller in aggregate volume than industrial consumption, this segment can influence retail premiums and regional availability. During periods of economic uncertainty, demand for physical silver often rises, leading to higher fabrication premiums and temporary shortages of popular products. These localized effects can create the perception of scarcity even when wholesale supply remains adequate. Understanding this distinction is essential to avoid conflating retail market dynamics with broader supply conditions. One of the most important shifts is how serious buyers evaluate risk. Rather than focusing on short-term price forecasts, they assess structural resilience. This includes the stability of supply chains, the reliability of refining and transportation networks, and the concentration of production in specific regions. A significant portion of global silver output comes from a small number of countries. Political changes, environmental regulations, or labor disputes in these regions can have disproportionate effects on global availability. These risks are not easily hedged through financial instruments and therefore influence long-term procurement strategies. Another factor shaping behavior is the increasing transparency of market data. Exchange inventory reports, customs trade statistics, and corporate disclosures provide more information than in previous decades. While these data sets are imperfect and often delayed, they allow analysts to identify trends such as rising import demand in key manufacturing hubs or declining export volumes from major producing countries. Over time, these patterns contribute to a more nuanced understanding of underlying market conditions, even if they do not translate directly into immediate price movements. Despite this, retail market participants often remain focused on simplified narratives. Media coverage frequently emphasizes daily price fluctuations or short-term technical patterns, which can obscure the slower-moving structural changes. This creates a gap between perception and reality. For example, a period of sideways price action may be interpreted as lack of interest, even as industrial consumption continues to grow and inventories gradually decline. Conversely, sharp price rallies may attract speculative attention without reflecting any fundamental change in physical supply or demand. Risk misinterpretation is another common issue. Some retail investors assume that holding silver automatically provides protection against inflation or currency weakness. While silver has historically performed well in certain inflationary environments, its behavior is influenced by multiple variables, including industrial demand cycles and broader commodity market trends. Without understanding these drivers, investors may develop unrealistic expectations about performance and timing. Professional market participants tend to mitigate these risks through diversification and disciplined position sizing. They rarely allocate capital based on a single thesis. Instead, they integrate silver exposure into a broader framework that includes other metals, energy commodities, and financial assets. This approach reduces reliance on any one outcome and allows portfolios to adapt as conditions change. The concept of volatility also takes on a different meaning in this context. Increased price swings do not necessarily indicate instability or dysfunction. They often reflect the market's attempt to reconcile competing forces, financial flows responding to macroeconomic signals, industrial demand anchored in long-term growth trends, and supply constrained by structural limitations. When these forces move in different directions, prices adjust more frequently and with greater amplitude. For disciplined participants, this environment can offer opportunities to rebalance positions or secure long-term supply at favorable terms, rather than serving as a source of uncertainty alone. Another area of frequent misunderstanding is the relationship between silver and other precious metals. While silver is often grouped with gold, their market structures differ significantly. Gold demand is dominated by investment and central bank activity, whereas silver's demand profile is more industrially oriented. This difference affects how each metal responds to economic cycles. During periods of industrial expansion, silver may benefit more directly from manufacturing growth. During financial stress, gold may attract a larger share of safe haven flows. Recognizing this distinction helps avoid overly simplistic comparisons and improves strategic allocation decisions. As these dynamics evolve, the silver market is increasingly shaped by long-term structural forces rather than short-term speculation alone. The energy transition, digitalization, and electrification trends are not temporary phenomena. They represent multi-decade shifts in how economies function and how resources are allocated. Silver's role within these systems gives it a different profile than in previous cycles, when photography and jewelry dominated demand. For market professionals and serious investors, the challenge is not to predict short-term price movements, but to interpret how these structural forces interact. This requires patience, attention to detail, and a willingness to look beyond headline narratives. The market is not offering simple signals or binary outcomes. Instead, it presents a complex set of variables that evolve gradually, shaping the environment in which silver is traded, consumed, and stored. This broader perspective sets the foundation for understanding why the current phase is less about dramatic turning points and more about incremental adjustments. The final piece of the picture lies in how these trends converge over time, influencing behavior, expectations, and the strategic decisions of participants across the entire silver ecosystem. As these structural forces continue to converge, the silver market is entering a phase where long-term discipline becomes more important than short-term conviction. The combination of steady industrial demand, limited supply elasticity, and evolving delivery dynamics does not create a single dramatic inflection point. Instead, it reshapes the environment in which participants operate, gradually altering incentives, risk management practices, and capital allocation decisions. One of the most notable implications is the changing role of inventory. In earlier cycles, large above-ground stocks provided a substantial buffer against fluctuations in mine output and demand. Today, that buffer is thinner relative to the scale of industrial consumption and financial exposure. This does not mean inventories are disappearing, but it does mean their turnover has become more significant. When metal moves more frequently between vaults, manufacturers, and investors, the system becomes more sensitive to logistical disruptions and timing mismatches. For market participants, this places greater emphasis on understanding where metal is held, under what conditions it can be accessed, and how quickly it can be mobilized. This environment also changes how risk is distributed across the market. Producers face decisions about whether to hedge future output in a market where delivery conditions may tighten. Industrial users must balance cost control with supply security. Financial investors, meanwhile, must consider not only price exposure, but also the structural characteristics of the instruments they use, including the differences between allocated and unallocated holdings, exchange-traded products, and direct physical ownership. Each choice carries distinct implications for liquidity, counterparty exposure, and access to metal during periods of stress. Another important development is the growing integration of silver into broader sustainability and technology strategies. Government policies supporting renewable energy, grid modernization, and electrification indirectly influence silver demand by accelerating deployment of silver-intensive technologies. While policy frameworks evolve over time, the overall direction toward cleaner energy systems and digital infrastructure is unlikely to reverse. This creates a demand backdrop that is less cyclical than in the past, even if short-term fluctuations remain. At the same time, the market continues to rely on global supply chains that are exposed to geopolitical and economic uncertainties. Transportation costs, energy prices, and regulatory environments all affect the cost and speed of bringing silver from mine to end user. These factors do not operate in isolation. They interact with currency movements, trade policies, and regional economic conditions, creating a complex landscape that requires continuous monitoring rather than static assumptions. For investors and professional buyers, this reinforces the importance of process over prediction. Rather than attempting to time precise entry or exit points, many focus on building positions gradually, maintaining diversification, and adjusting exposure as new information emerges. This approach reflects an understanding that structural changes unfold over extended periods, and that markets rarely move in straight lines. It also reduces reliance on short-term signals that may be driven by transient sentiment rather than underlying fundamentals. Education and transparency play a growing role in this process. Participants who invest time in understanding market structure, delivery mechanisms, and demand drivers are better positioned to interpret signals that others may overlook. This does not guarantee superior outcomes, but it improves the quality of decision-making and reduces the likelihood of reacting emotionally to volatility. In a market where narratives can shift quickly, a disciplined framework provides stability. It is also worth recognizing that silver's evolving role does not eliminate uncertainty. Technological innovation can change material usage patterns. Efficiency improvements in solar manufacturing, for example, have reduced the amount of silver used per panel over time, even as total demand has grown due to higher production volumes. Substitution and recycling technologies continue to advance, potentially altering long-term supply and demand balances. These developments highlight the need for continuous reassessment rather than fixed assumptions. What distinguishes the current environment is not the presence of risk, but the nature of that risk. It is increasingly structural rather than speculative. It arises from the interaction of physical constraints, industrial growth, and financial market behavior. This type of risk does not manifest through sudden dramatic events alone. It accumulates gradually, influencing market behavior through subtle shifts in pricing, inventory management, and participant strategies. For a global audience of investors and market professionals, the central takeaway is the importance of perspective. Silver is not transitioning into a fundamentally different asset overnight. It is adapting to new economic realities and technological priorities. Recognizing this adaptation requires patience and a willingness to engage with complexity. It also requires avoiding simplistic conclusions based on short-term price action or isolated data points. The market is sending signals, but they are not the kind that fit neatly into headlines. They appear in inventory trends, delivery patterns, industrial procurement strategies, and the evolving relationship between paper instruments and physical metal. Together, these signals suggest a market that is becoming more tightly connected to real-world demand and supply conditions, even as financial liquidity remains high. In this context, the most productive response is not to seek dramatic forecasts or definitive turning points. It is to build a framework that accounts for structural change and emphasizes resilience. For long-term participants, this means aligning strategies with underlying economic trends, maintaining disciplined risk management, and staying informed about the mechanisms that drive market behavior. Silver's current phase is best understood as a period of adjustment rather than upheaval. The foundations of the market are shifting gradually, influenced by industrial transformation and evolving financial practices. Those who approach this environment with a long-term mindset and a focus on fundamentals are better positioned to navigate the changes ahead, not by chasing short-term movements, but by engaging with the deeper forces that are shaping the future of the market.